Hello learners, welcome to our session today. I am your instructor CPA Ringo Fredrick. It is a continuation of what we were doing earlier on. So in today's class, my good students, I want us to introduce theories of valuation of financial assets. Remember last class we had talked about the reasons why valuing financial assets is important. So today I want us to talk about the theories. I want us to talk about theories on valuation of financial assets. Theories on valuation. Talk about theories on valuation of financial assets. Theories on valuation of financial assets. Theories on valuation of financial assets. I want us to talk about theories on valuation of financial assets. A very important concept that I want us to talk about. So looking at the theories on valuation of financial assets, my good students, we normally tend to talk of three main theories. These will include, number one, fundamental theory. Number two, we'll talk about technical, at times known as chartist theory. Number three, we will be talking about random walk theory. I know this is very common to finance students. Random walk theory. So anytime we'll be talking about valuation of financial assets, my good students, we'll always be talking about these three theories mainly. That is the aspect of fundamental theory, talk about technical theory, we talk about random walk theory. Let us start by the first theory to see what it will entail. Let us start by looking at the fundamental theory. Anytime you're talking about fundamental theory, what should click at the back of our mind? Anytime you're talking about fundamental theory, what should click at the back of our mind, my good students? So looking at fundamental theory, ideally, we are looking at this theory normally tend to state that every security has an implicit value, which is equal to the present value of all cash flows expected from the company. We are saying that this theory states that every security has an implicit value which is equal to the present value of all cash flows expected from the company. The value of the security should therefore be equal to the present value of all future benefits expected from that security. We are saying that the main key element under this theory, we normally tend to say that the present value, or rather the value of we normally tend to say that the value of the security, that is the present value of the security. The present value of the security, present value of the security, present value of the security should be equal to the value of the security should be equal to the present value, should be equal to the present value of the security, should be equal to the present value of the security. So we are saying that the value of the security should be equal to the present value of the security of all the future benefits expected from that security. So ideally you are saying that at any given point, this theory, fundamental theory, key element is whenever we're talking about the value of the security, the value of our security should be equal to the present value of the security and all the future benefits expected from that security. For us to value a security, we should make sure that it is equal to the present value of the future benefits expected from that security. That is fundamental theory. The assumption is that at this point, the assumption is usually that a company normally tend to have a constant dividend policy. A company, the assumption of this theory is the company has a constant dividend policy. It does not change. If we agree that we'll be paying, say, like a certain percentage of our amount, that is what we'll be paying. So it will not change. It will not change. It will not change. So after we've talked of the fundamental theory, that should take us to number 2, which in this case we'll be talking about the technical theory. Talk about technical theory. Talk about technical theory. So, talking of our technical theory, my good student, we normally tend to term it as this theory normally holds that historical price patterns are expected in the future. It normally tends to hold that historical price patterns are expected in the future. That is one key element of this theory, that the historic price pattern are expected in the future. Meaning that if there was a time that I was selling these shares at 100, I should expect that in future, as much as changes come into place, still I'm going to sell these shares at 100 at one point in time. If I was selling them at 200, it states that at this point, at one point in time in future, still, however the changes in the market, I'm going to return back to 200 shillings at one point. So that's why at this point you'll find that this theory, it normally tends to talk of two concepts. The first one, we normally tend to talk about primary movements. We normally tend to talk about there's that aspect of primary movement. Talk about secondary movement. And talk about tertiary movement. We normally tend to talk of 3 factors on this. That is primary movement, secondary movement, and tertiary movement. So explaining the primary movement, my good students, for us to grasp it correctly. Anytime you're talking about primary movement, ideally, these are kind of long-term in nature. The changes that are in long-term in nature. These are trends that represents a period greater than 1 year. It is long-term in nature. And you are saying that at this point, this is a long-term in nature. And you are saying that it represents the pattern. It represents a period greater than 1 year. This trend will occur after a long period of time, usually more than a year. Because remember, we are assuming that these price patterns, the historical price patterns, are going to be seen in future. That is what we've talked about, the aspect of technical theory. So we are saying that at this point, this theory normally assumes that this trend will kind of appear after 1 year. So that's why you're terming it as a long term. Secondary movement, we normally term it as a seasonal variation. And you'll find that anytime you're talking about seasonal variation, at this point you are looking at it as a case whereby this item is going to change over a very short period of time, meaning that it's kind of the share price capturing periods covering several weeks. This aspect, the changes are kind of very seasonal, meaning that they are short term and can take up to, say, like weeks for us to start seeing these changes, to return back to where we were. Tertiary refers to daily changes. So this refers to daily changes in stock prices. It refers to daily changes. in stock prices refers to daily changes in stock prices. That's why you'll find that many a times, each and every day, we normally tend to talk about the closing rate of securities, daily changes in stock prices, daily changes in stock prices, daily changes in stock prices. And that's why we are saying that each and every day, we normally tend to talk about the shares have closed by this, the shares have closed by this, meaning that our prices are changing on a daily basis. This one, we're looking at it weekly. Primary movement, we're looking at it on a very long-term period, So in the event that you're told to explain the concept of technical theory, just know that we are looking at a theory which tend to explain the changes of shares. And it normally goes with an assumption that at this point, the historic prices might also be seen in future, might occur again in future, So that is a technical theory. What about the random walk theory? A very common theory in finance, We normally tend to talk about random walk theory. Random walk theory. We normally tend to talk about the random walk theory. What should we be having at the back of our mind anytime you're talking about that? Just a moment here. So, just a moment. Random walk theory.